Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. One of the companies that's gotten a lot of attention from investors periodically over the last decade or so is Plug Power. It's reasonable to be excited about the future of hydrogen and its potential use cases in the electric system, in vehicles, in industry. There's a lot of things that we could be doing with hydrogen. But that doesn't mean that Plug Power is a great stock to own long term. In fact, I think this is one of the worst stocks to hold long term, and I will explain exactly why. I want to go through a lot of the numbers here from an operations standpoint, and then what management is doing with the stock and how it's destroying value long term. My name is Travis Hoium. Thank you for watching Rive Investing. Please subscribe here on YouTube for all my investment coverage, including in the renewable energy space. Now let's go through a number of charts here to show exactly how Plug Power is doing both well and struggling at the same time. And the first thing I'll start with is revenue. It's hard to argue that Plug Power hasn't done a great job growing revenue. This is a 5-year chart, but you can go back further than that. The company has really been a growth machine, primarily selling things like hydrogen fuel systems that are used for forklifts and other materials moving devices. Is not a company that's selling a lot of products that are used in vehicles and things like that. That's a common misconception there. That may change in the future, but primarily their business is selling fuel cells that are in places like Amazon and Walmart warehouses. But if you add in the net income the company is generating to this chart, you can see that net losses actually exceed revenue. And there may be one-time things here or there. This is a trend that we see over and over and over for Plug Power. The company continues to grow, but continues to lose money in the process. Add in free cash flow, and the picture actually gets worse. They're burning far more money in free cash flow than they're generating in revenues. This is simply not a sustainable business. There's no question about that. Management has said over and over and over again over the past decade that they're going to get to adjusted EBITDA break even. I will link to an article that I wrote years ago about all of the times that they had said that they were going to be adjusted EBITDA break even, which should be a proxy for cash flow break even, and they have still never hit that mark. So how does a company like this keep losing money and yet stay in operations? And the answer to that is they keep issuing stock. You can take this chart from almost any time period, but I just took it down to the max that YCharts goes back to, which is back into the late 90s. And you can see that shares outstanding continue to grow year after year after year, particularly in these areas of high interest. Now, management does do a great job issuing stock in a number of different ways when the stock is really valuable. So in the early 2010s, there was a bunch of interest in hydrogen and in Plug Power, and they issued a whole bunch of stock, a lot of that to Walmart and Amazon through warrants that those companies got for becoming customers. And then again, during the pandemic, when there was a lot of interest in hydrogen and alternative energies, and the company got a lot of outside investment that once again is in the form of stock, but that more than doubled the shares that are outstanding. This is the craziest number right here. The number of shares outstanding is up 27,570%, or 276 times since the late 90s. This is absolutely not what we want to see from a company, is issuing so much stock that you're diluting shareholders this far. And what has the stock price done over that time? Despite the fact that this is a really valuable company today, the stock is down 63% since the late 90s. So issuing stock, continuing to issue stock and lose money has not been a way to add value to shareholders long term. There may be periods of time where the market's attention for this stock helps push the price higher. And I fully admit that this is a management team that does a really great job at getting the right kind of media attention to get traders to buy the stock and push the stock higher. But long term, we simply don't see any value being created for the company. And if you're like me and you're a long-term investor, I don't know what a stock is going to do today, tomorrow, next week, but I know that if I buy great companies and hold them for a long period of time, that will help grow my portfolio. This is not a great company. Holding it over a long period of time destroys value, and there has been no indication at any time in the last 25 years that Plug Power will ever be able to turn a profit. I'm willing to be proven wrong, but that has been the same story for the last decade or more that I have been covering this stock, and it's the same story today. So that's why Plug Power is one stock that I will be staying out of. Do you feel differently about Plug Power? I'd love to hear your comments in the comment section below. Please follow Rive Investing here on YouTube. Thank you for watching, and I'll see you again next time.